Joining us now on his outlook for M&A, RBC Capital Markets Head of Global M&A, Vito Sperduto. He's coming to us from the firm's Technology, Internet, Media, and Telecommunications Conference. Vito, welcome to the show. It's great to have you on.
Well, Morgan, thank you for having me today.
We had seen a real dearth of activity the end of last year and into the beginning of this year, but seems like more recently that's starting to pick up. Your take?
Sure. I think at the end of last year, we were all expecting that this year was going to be a flip or a reverse of what we saw in 22. Certainly the first half was basically equal to the second half of 22. And then it's been a bit slower. I think the rate hikes have gone longer. I think some of the geopolitical concerns, the financing markets haven't been as stable to be constructive to allow us to do more M&A. And so it's kind of pushed to the right. We've seen some pockets of activity. You mentioned a couple of the deals in the oil and gas space. We've certainly seen cash-rich corporates take advantage of this environment and execute on some of the M&A transactions that they've been looking at for some time. And especially in an environment where private equity has been slower and probably not spending as much as they have historically, certainly within, if you look at the last 5 years. But I do think that the volume of activity in the U.S. this year will likely end up being close to even to what we saw last year. It's really going to be that global volume, which is going to end up down. And so global volume will likely end the year probably down 10 to 15% versus last year at about $3 trillion of M&A volume.
Okay.
And the U.S. will be strong, which I think is, again, it's the desired target market.
Okay. So you just said a lot. I'm going to parse some of it out.
Yeah.
And I'm going to start with the fact that we've seen the Fed raise rates more, at least earlier this year, than had initially been anticipated. I mean, you had this huge rally in the market today after the CPI print, largely because the market now thinks that that's it. The Fed's done raising rates. We're done here. I mean, it raises the question about higher for longer and what that looks like into 2024. But given that fact, does that mean, do you look at a day like today and a data point like the reading we just got on inflation and go, okay, here's the moment where you start to see deal activity pick up in a more meaningful way?
I think the moment we're going to see that is when we have some greater confidence that the Fed is done. Because at that point, there's greater certainty as to what the math or the numbers are going to be going forward. If I know that rates are going to be at this level or no worse than this level, I think I can plan for that. And I think the difficulty has been that it's uncertain as to when it was going to end. So I think once there's a strong conviction, a confidence that the Fed's done raising, even if we think that it's going to be higher for longer, or, you know, if you look at the different economists, some are saying second half of next year for cuts, some are saying longer, that doesn't matter. I think once there's a conviction that rates are at a level that it's the max we're going to see, you're going to see a fair amount of deal activity because there's such pent-up demand, both in terms of buy and sell side.
Yeah. You mentioned geopolitics, too. That got my attention. What you didn't mention was regulatory scrutiny, which we've seen so much of, including, I think, just today with European regulators taking a closer look at Adobe's acquisition of Figma.
Yeah. I think the regulatory scrutiny, as we've always talked about with our clients, good transactions get done. You plan for it. You need to have the wherewithal to last two things. One is you need to be able to spend additional time between sign and close of a transaction because those periods are elongated given these extended reviews. And then two, you need to have the financial wherewithal to be able to take this the distance. What we've seen in the U.S. is that the DOJ and the FTC have taken more aggressive tones in terms of what they're trying to enforce, in terms of the novel definitions that they're trying to enforce. But the reality is the large firms that have taken it all the way to court and have gotten to a decision, they've won 7 out of 8 times. And so I think that's emboldened a lot of players. Now, we can't lose sight of the foreign regulators that you've talked about. And I think that's part of the equation. And that's become a bigger piece, especially over the last 5 years.